The most powerful agency on the planet just made a decision that will affect nearly every aspect of your financial life. As we speak right now, the US Central Bank, the Federal Reserve, is setting policy that will affect every dollar in your life. Your bank account, your stock investments, your real estate. And this is not just for US citizens. This affects the entire world. Investing with the Federal Reserve decisions give investors a massive opportunity to invest alongside this powerful agency, while investing against the Fed has proven over and over again to have catastrophic consequences for so many investors throughout the brief history of the Federal Reserve. Now, the problem is the Fed is mysterious by nature. Very few people understand what the Federal Reserve is and how they make decisions that impact the entire world economy and, most importantly, your investments. Today, we're taking a deep dive into the Federal Reserve so that you can understand how the Federal Reserve works and how to be on the right side of the Fed's decisions for your finances and for your life. So, understanding the US Federal Reserve. When our founding fathers were designing the structure of the proposed United States of America, one discussion point was the conflict between those who supported establishing a central bank similar to the Bank of England, which was, for all intents and purposes, the most powerful bank at the time, and the other camp who opposed the concentration of that much financial authority in a central organization. This was a big conversation at the time. So much so that the first US Treasury Secretary, Alexander Hamilton, Hall of Fame American, he wanted to push strongly for a central banking authority. He wanted that concentration of power. While others like Thomas Jefferson opposed the creation, another Hall of Fame American. Jefferson, on the other hand, was concerned that a central bank would take power away from the states and actually give it to merchants and financiers to have a huge advantage over the little guy, like farmers, small business owners, and really the backbone of the US at that time. However, the US was in debt even from the beginning. So the debt crisis we keep hearing about is actually not new. Our country even started with this. So having to print money happened from the beginning to finance the American Revolution. In fact, Congress authorized printing of so much cash that it led to inflation again from the very beginning. So inflation is even a very American problem that we've had for hundreds of years. Congress established the first Bank of the United States in 1791, but this early effort was burdened by lack of authority, just really limited in scope, significant opposition from those that wanted to get rid of a central bank, and all in all, everyone agreed to just let that bank expire in 1811 when its charter expired. A few years later, however, Congress chartered the second Bank of the United States. Not really super ingenious titles, but very clear titles, which is good. This effort was also short-lived, however, and that charter for the second Bank of the US also expired in 1836. The result afterwards was really chaotic. It was a proliferation of state-chartered and unchartered free banks, which each issued their own notes, aka paper money. So you had just hundreds of different currencies that were going around the same country, the early US, and there was no universal agreement of value of that currency, what one currency was valued opposed to another. So finally, Congress, during the Civil War, so it took a really significant event for Congress to pass the National Banking Act of 1863. What this did was create national chartered banks, aka truly the beginning of the federal chartered bank system that we see today, and also to issue US government securities. The act did not establish a central bank, however, at this stage, so really the norm was state banks, and they continued to act freely, and still there was those conflicts between those different banks making different policy decisions at the time. Eventually, with this kind of cowboy behavior between banks at the time, there was banking panics in 1893 and 1907. So what was Congress to do with all these banking panics? They created the Aldrich-Vreeland Act of 1908. And what this did was allow the US to issue emergency currency during financial and other crises that could come up. And it also created the Monetary Commission to research options that were available to resolve the US's continual just turmoil in the financial sectors. So now we're starting to see the early stages of building out structures to backstop financial crisis in the early US. So in this case, the third time was the charm, because what happened was President Woodrow Wilson ended up supporting the House Committee on Banking and Finance bill that ended up crafting a proposal for the first central bank in US history. What this proposal ultimately offered was a decentralized central bank. How does that happen? So it's decentralized, but it's also a central bank. We'll dive into that in a moment. This decentralized central bank balanced the interest of both the private banks and the public concerns, meaning everybody in the country at the time that wasn't in banking. President Wilson also signed this landmark Federal Reserve Act, into law December of 1913. The result was a bank that was decentralized by dividing the banking into 12 regional reserve banks. This is important because this is the system of what the Federal Reserve is still to this day. And again, the goal was to have a central bank, but still the roots were decentralized, essentially appeasing and finding a good balance of both. After World War I, economists and policy leaders accepted the fact that we really actually needed a centralized authority on things like finances, market conditions, etc. There had to be one voice that in the middle that steered policy. One of the strongest reasons for this at the time was the reality that the reserve banks had demonstrated huge value during the war by facilitating financing of the war efforts. So the fact that we even had a successful war was majorly in part to the finance of the early US. The head of the New York Federal Reserve used this as an opportunity to act aggressively to thwart a recession that was looming and that was brewing after the war by purchasing a large amount of government securities. For those that understand the basics of the system, this is the first example of what's called open market monetary policy, meaning this is the first quantitative easing in US history, right? And it was so long ago. We want to think about a lot of the policies today, especially the Bernanke era of the Federal Reserve, as this whole new chapter of American history. The reality is, so many things of the Federal Reserve today are taken one page at a time out of history. This is one of the earliest examples of major tools that we use today that was actually used quite a while ago effectively. Let's jump back in. What reforms resulted from the crash in the Great Depression, which is the worst economic crisis we've ever had? Between 1930 and 1933, over 10,000 US banks collapsed as the country endured the worst depression we have ever had. This is where the blame starts flying, and this is where it gets interesting. Some people blamed the loose banking regulations that allowed these banks to engage in speculative lending. Things like huge margin strategies where things just snowballed into terrible outcomes by people being speculative with the stock market. Others also argued that the Federal Reserve needed to act more aggressively and rein in a lot of this behavior. So in response, Congress passed what's called the Glass-Steagall Act. But more importantly, it was also known as the Banking Act of 1933. What this Banking Act of 1933 did was a few major powerful things that created a part of the system that we have today. Separation of commercial and investment banking interests. So this split the front and back halves of the bank. Us as consumers were no longer at risk for the investment side of a bank's decisions. Next was the use of government securities as collateral for the Federal Reserve notes, AKA the money, the paper dollars that people were using now had a literal asset that backed up those dollars, so people had more faith that that currency wasn't just worthless or backless. This Banking Act also created the FDIC, which we still have today. That's the Federal Deposit Insurance Corporation. So the FDIC is an interesting note because it does back up many of the deposits that you hold in banks, notably up to $250,000. What I'll also make a note of here, just because it's interesting and beyond the scope of this video, I do recommend you check into what investments at your bank are backed up by the FDIC and which are not. I think the answer will surprise you and give you a better understanding of the investment world and what is actually guaranteed and what is not. Next, the act created required examinations of the holdings, the investments that banks had, and the companies that they were invested in as well. So more transparency and more looking into the books. Here's an interesting note. We'll pause to talk about a historical moment. The Gramm-Leach-Bliley Act in 1999 revised and revoked many of the provisions of the Glass-Steagall Act of 1933. Why is this important? Because many people point to that moment in 1999, repealing a lot of these regulations, as the biggest contributing factor to the 2008 financial crisis. While Glass-Steagall provided an open market policy, the Banking Act of 1935 created the Federal Open Market Committee. So that you better understand, the FOMC is separate from the 12 regional reserve banks. For this reason, and with the goal of being decentralized in nature and having a good distance from parts of the Fed to make their own decisions independently. So, maintaining the independence of the Federal Reserve Board of Governors. How do we do this, and how is this achieved in the US? As mentioned, the Federal Reserve System is comprised by 12 different regional reserve banks. Next, we have the Federal Open Market Committee, the FOMC, and then on the third hand, we have the Board of Governors. The Board of Governors is based and headquartered in Washington, D.C., and has 7 members. Each of these 7 members are appointed by the U.S. President. Now, while these 7 members are subject to Senate confirmation, which is a very important point, this is where politics overlaps with the independence and the separate idea of the Federal Reserve, because the president appoints these individuals. So while the Senate would need to approve these appointments, the reality is many times in the US political history, you see a president and the Senate with the same political party in control of both. This is one of those moments where we can see a huge and long future of financial policy being set by one party. Now, there is a benefit to the long terms, and that is that they're a little more insulated from the political process, or at least that's the goal. And there's also the fact that there's really not a method, or an established method at least, for removal of these sitting individuals. Now, here's an important point. The president also selects the chair and vice chair from the current members. Again, those are members that were selected by either that president or a previous president. So not only do they select members for the committee, they also select the chair and vice chair. So the president of the United States actually has a pretty big role in financial policy during their term with regards to the Federal Reserve's actions, because they choose the decision maker and who's driving that bus for their terms. When a member is chosen as the chair or vice chair, they sit in that role for a 4-year term. However, much like the president, they can be reappointed for a second term, and very typically they are, especially in times of crisis, which you can see throughout the history of the Federal Reserve. According to the original Federal Reserve legislation, the governor should represent the country's financial, agricultural, industrial, and commercial interests. This, if you want to think about it in terms of mandates, is their goal at all times, to think about those 4 areas of the United States. And for these 14 members, their terms are staggered. I actually really like this. They're staggered, with one governor's term expiring every 2 years. What this does with those long terms that they have is provide more independence and basically have that revolving door of new fresh blood in there, new fresh ideas in there, new fresh policy options in there, while still having some senior members that can give in some of their economic advice or policy input from their own experience sitting on the board. Additionally, this system actually has a really good check and balance with how they elect individuals to the board, because there's a good amount of geographic diversity. Only one governor can be from any one specific Federal Reserve district. and at least one member of the board must have experience with community banking. So what this does is not over-concentrate power or interests in any one region of the country. Instead, it's rotated pretty strongly, and so we have most of the country coming together to make decisions for the whole. This is where it gets a little tricky, so pay attention. Those 7 governors we just spoke about, and 5 of the 12 regional bank presidents that we talked about previously come together to form the Federal Open Market Committee, which arguably gets the most press and the most interest from their meetings because often rate policy is set by this group. And so not only do they set interest rates, but they also manage the general money supply in the United States. So the FOMC has individuals from multiple groups and has a massive role within the Federal Reserve. The FOMC has 2 goals, 2 mandates. The first is stable employment, and the second is stable monetary policy. Another way to put this is full employment, aka low unemployment, and stable policy, aka meaning stable and low inflation. Specifically, the target for unemployment, let's say between 4 and 5% to put a number to it, while the target for inflation on average is just 2%. Between these 2 mandates, the FOMC must balance the economy to not overheat and to not cool off too much into a recession to maintain levels around those stated numbers. All right, so what are the functions of the Federal Reserve today, having said all that and learning a lot about the past? So the modern Federal Reserve has continued to evolve, just like any government agency, and it has assumed an even more prominent role specifically in US economic policy on a broader scale. If you want to think about the overall goals of the Federal Reserve, here are the 5 primary functions that the Fed focuses on today. The first is conducting U.S. monetary policy to pursue maximum employment and stable prices while also moderating long-term interest rates. So between those 3, the Fed needs to balance their policies around that. The next is to promote the stability of the U.S. economy and contain systemic risks, not letting any one risk get out of control while still making sure that there are big opportunities for businesses and banks to tap into in the economy. Number 3 is promoting the safety and the soundness of individual financial institutions so that no power is over-centered in our country and the individual financial institutions can still thrive in the system. Next is fostering payment and settlement systems effectively and safely. So this is the fact that we all want to be able to send money back and forth, and you think about this on a broader scale, 300 plus million people and thousands of businesses, they need to be able to settle transactions quickly. The Federal Reserve makes sure that they can keep that efficient and safe. And last but not least, number 5 is promoting consumer protection. So the Fed's responsibility is to us as the consumers, to us as the citizens, to keep us safe from financial collapse, really, in our country. Today's modern Federal Reserve is a vast and really kind of complex system, as we just went through. And the reality is there's really well-known pieces and some that are just not well-known because they're not as sizzling as, let's say, the Federal Open Market Committee's rate decisions. Most public attention focuses on the Board of Governors and the FOMC because it has the biggest levers that are pulled with the most direct and quick turnaround impact on the US economy. All that said, though, the Federal Reserve does have a pretty wide suite of powerful tools that it uses and employs really at their discretion, more or less at their sole discretion, to manipulate the economy for the outcome that they're looking for. So let's use the example of interest rates. This is by far the most visible and on people's radar of the tools that the Federal Reserve uses. The truth is that the Fed does not actually directly determine the rate that consumers pay for loans at banks and financial institutions. Instead, what the Fed does is determine rates in 2 different ways. The first is that the Fed sets what's called the federal funds rate, which is often also called the Fed rate or the overnight rate. So what this rate does, the Fed rate does, is change the amount that banks charge each other to borrow within the system either overnight or short term. So it might be a situation where one bank is flush with cash and one bank has lent out all their money and they need some. So they lend money back and forth, and the rate at which that happens is the Fed rate. Now, this is not to be confused with what's called the Fed discount rate, which is the rate which the Fed charges to banks when the Federal Reserve loans them money. This rate is nearly always higher than the federal funds rate for the reason that the Fed wants to incentivize banks to borrow from each other rather than always calling on Daddy Fed to give them a loan from the Federal Reserve. Here's an interesting note though. When things do hit the fan, like let's say the COVID-19 pandemic started, we saw that the Fed in March 2022 pretty much narrowed the difference to nil between the overnight rate and the discount rate. Why? Because what the Fed was looking for in that kind of moment was just to get cash to banks. It wanted to make sure that banks were capitalized, banks had the money they needed to support the financial system in the US. We saw the massive swings in the stock market. We saw the massive swings that businesses went through. The last thing the Federal Reserve wanted was to have a system that didn't have enough cash to support itself. The Fed also extended the period of allowable borrowing to 90 days, giving a lot more tolerance and a lot more flexibility for those banks as well. So when the Federal Reserve raises or lower rates, financial institutions generally mirror those changes with what they end up charging customers, aka us, the consumer. So, in a simple example, if the Fed increases the Fed rate by 1%, which is also called 100 basis points with the finance industry, the bank from which you borrow money as a consumer, whether that's a credit card or a home loan or an auto loan, that rate will likely increase from that bank to you. The bank will often also increase the amount it pays for savings and other deposit accounts. Although, worth noting that sometimes can lag a little bit behind what the Fed rate increases look like. So you're telling me when rate changes happen that benefit banks, they're Johnny on the spot and they make those changes immediately. But when rate changes happen that benefit consumers, banks are a little slow to implement? Yes, that's what I'm telling you. That's dead on. All right, now let's drill down a little bit on how this impacts you as the consumer. Let's talk the two biggest loan types, fixed rate loans versus adjustable rate loans. The most immediate effects are going to be on adjustable rate loans. So the obvious examples are things like credit cards that will change and adjust as rates change and adjust. Typically, credit cards follow a calculation that uses the prime rate, as it's called, plus a calculation to land on what you are charged. On the bigger dollar side, most Americans with mortgages are significantly impacted by rate changes only if they're on variable rate mortgages. The good news is that most Americans today have mortgages that are fixed rate loans, so they don't really have to worry about their interest rate changing or potentially going through the roof on their payment like it did in the global financial crisis. This was one of the biggest drivers of the global financial crisis because adjustable rate mortgages, which aren't just unique to mortgages on homes, but also can be through vehicles, etc. They're often cheaper than fixed rate options. So many borrowers will go for the adjustable rate thinking they're saving money, but then when the market changes and that ticks up, their payment is beyond what they can afford. This widespread use of adjustable rate loans, massively generous terms, and really even lowering lending standards were super common in the lead up to the housing crash of 2008. This is what caused the great financial crisis that really was the greatest financial crisis in our country's history. All right, so how do rate changes impact the country on a wider scale? So an increase in the Fed funds rate makes borrowing more expensive. We already know that. But what this does is actually reduce spending, because in the economy, if things are more expensive, people do less of it. The trick is for the Fed to find a balance, to find a rate that encourages a really high level of spending, a healthy level of spending, if you want to think of it that way, so that the economy continues to grow, but employment's also stable without overheating the economy to a degree that starts to cause inflation. Because if things are heating up so much and people have more money in the system, they start to bid up prices on things, whether that's labor or eggs or cars or gasoline, that causes inflation. So in short, the Fed's goal is to make the best economy that they can have while still keeping that 2% inflation target. The next tool we'll jump into is reserve requirements. This tool in the Fed's quiver is the ability to control how much in reserve banks will hold as required by the Federal Reserve's mandate to those state and federally chartered banks. A reserve requirement is the percentage of a bank's liabilities that it must hold in cash. And that's either in its literal vault or in an account with the Federal Reserve. So this is an amount of money that is held back from the bank transacting with and really slows them down both in a good way and a bad way. Let's do a case study. Suppose the Fed reduces the reserve requirement, just like it did at the beginning of COVID-19 for mini deposit accounts for many banks. This act of reducing reserve requirements is considered what's called an expansionary monetary policy, aka the goal is to stimulate the economy with this. What this does is it allows more money to flow through the economy from more banks. Because banks have a smaller reserve requirement, they can lend out more money into the economy and stimulate it and keep things moving. This increases growth and potentially contributes to inflation on the other end. So finding a balance here is extremely important. Next up is open market operations. Open market operations involve selling and purchasing securities in the open market by the Federal Reserve. So this is the ability for them to influence the monetary supply on a very big scale. These operations are really quantitative easing and quantitative tightening. Many people are familiar with this because the impact is so powerful and because it's been used more and more in recent cycles. If the Fed wants to reduce money supply, it can sell securities, which then will raise interest rates. So there's two levers that can be hit with one action. The Fed can also buy securities if it intends to increase the money supply. So if the Fed goes out and removes all these assets from the marketplace, it trades those for lots of money into the marketplace. Pumping this money into the marketplace is called quantitative easing. The Fed does this with hundreds of billions of dollars in assets at a time. So when the Fed does make these moves, quantitative easing for instance, it purchases assets and puts hundreds of billions into the marketplace. Usually it does this with treasury bonds, mortgage-backed securities, and even federal debt. This tactic not only adds money to the economy and stimulates it from that angle, but it also increases demand for securities that the Fed has purchased and makes more cash available for banks to lend through that avenue as well. These quantitative adjustments complement interest rate changes. They can, if done correctly, work in conjunction for a very good outcome from both angles. For example, quantitative easing actually helps reduce longer-term interest rates, while changing the Fed funds rate, on the other hand, has more of an impact on short-term rates. During the great financial crisis, when the Fed was fighting a major looming recession, it cut interest rates to literally 0%, as low as it can go. At that point, the Fed had very few options, so they really started pulling out all the stops in other ways. They used their authority to purchase mortgage-backed securities and US Treasury notes to keep the longer-term rates low and to send a message to the market that the Fed was not going to leave the financial markets high and dry in the US. During COVID-19, the Fed returned to this playbook and they used quantitative easing again to keep the economy flowing and to have cash moving things along. So let's take a second and drill down on this process so we really understand what quantitative easing looks like. First off, the Fed buys long-term treasury notes from dealers in the open market. They throw huge amounts of weight around. Them purchasing something, again, is typically to the tune of hundreds of billions. Since the Fed can pretty much spend without a restriction, and by the way, this is what they do when they print money. Factually, technically, they don't actually print money at all. That's the Treasury Department's job. But the Fed does create reserves on its balance sheet specifically for this purpose and can kind of invent money in that way. It can continue this practice for as long as the Federal Reserve believes it's prudent. So in the wake of COVID-19, we saw the results, and that resulted in inflation. but financial institutions will have more cash, which they can then lend and keep on hand or use to finance other purchases to keep that system running on their side. In many ways, this is a great thing. It increases the economy, it increases money in the economy, it increases liquidity, and it also makes it easier for us as consumers to get access to money to really live our lives. Most commonly, you'll see interest rates continue to decline in that situation, meaning bond prices increase and yields end up falling. So, how do investors react? Many will react by changing their portfolio to favor stocks in environments like this, and then that also pumps up the market again by creating more gains in equities. The snowball increases because these gains in the stock market then increase consumer confidence, which is a major metric for a consumer economy like the US, and this continues supporting economic growth. Okay, so now we have an idea what quantitative easing and tightening look like. But what about the US debt ceiling? How does this all impact the US debt ceiling, which we deal with every couple years? For those that aren't aware, the debt ceiling is the maximum amount that the US federal government can borrow to pay its bills. The obligations that are subject to the debt ceiling limit include very important programs like Social Security, Medicare benefits, military salaries and support, tax refunds, interest on other national debt, and a bunch of other line items that only get worse from there. Once the United States reaches that amount, the debt limit, which is about 100% of GDP today, gross domestic product of the US, the Treasury can't continue issuing bills, notes, or bonds. It is a complete gridlock for the system. The debt limit is not a spending bill. Increasing the debt limit allows the Treasury to continue paying things that Congress has already authorized. So in the past, raising the debt limit was considered almost automatic, and it really wasn't subject to so much political saber-rattling and maneuvering and negotiation. But we've seen that much more common in the last, let's say, 10 to 20 years in Congress. Since 1960, Congress has taken action to revise and extend and increase the debt ceiling on 78 separate occasions. It's important to note here that this occurred under both Republican and Democrat administrations, meaning both are very complicit and 100% involved in increasing our national debt, which is snowballing dramatically. Most recently, Congress and the president have clashed over the debt ceiling as part of a broader conflict over budgetary priorities. While this is nasty and this does create gridlock, it is a good opportunity for different times in the political cycle for both sides of the aisle to come together and sort through the most important things. The debt ceiling as we know it today was created in 1917 and even had the initial purpose of measuring and stalling, and was created with the purpose in mind of managing fiscal responsibility for the federal government. However, the US government has always avoided defaulting on its debt, which could be catastrophic for investors and really for our entire economy. Now, what's interesting on the debt ceiling is that there are actually some really smart experts that believe that the debt ceiling is in violation of the 14th Amendment to our Constitution, which states plainly that the public debt of the United States shall not be questioned. Even that statement kind of raises a lot of questions, but they do have a point that the 14th Amendment does not seem to be in tow with what we're doing today with the debt. Rising public debt actually ignites conflicts across the board in the economy, and while the US has had the debt ceiling in place for over 100 years, the authorized spending in recent years has resulted in over a threefold increase in US debt since 2009 alone. The US federal government of today spends more annually than it receives by an extremely wide margin. The difference in 2024 was 1.9 trillion, and that was up from 1.7 trillion in 2023. The current national debt that we have in the US today is well over 35 trillion, and it's expected to grow at almost $1 trillion a quarter if something doesn't change. So the biggest risk that we face in a situation like this is downgraded credit ratings, which will increase the cost of borrowing and disrupt our investment markets dramatically. And again, the US has never defaulted on its debt obligations. But the negotiations over raising the debt limit have become pretty regular in modern politics. In 2011, for instance, the deadlock over the debt ceiling continued until very close to the date when literally the Treasury would have run out of money for the entire country. This is scary at the fundamental level of who's in charge and how are they managing it. The stock market tanked as a result of this, particularly since Standard & Poor's, aka the credit rating agency S&P, downgraded the credit rating of the US federal government due to this issue. That single downgrade may have increased the cost of borrowing money for the entire country. From there, the stock market suffered a loss of approximately 15% during that crisis alone, with additional problems experienced by stocks with greater exposure to US spending. Sadly, this isn't the end of the story, and our credit rating as a country was downgraded again in 2023. But strangely this time, the stock market didn't really react much. So whether that's we're just kind of used to bad news on one side, or whether that's the market didn't agree with the down rating, it was an interesting thing that we hadn't seen in history before. Whatever the case, concerns about a default can shake consumer confidence to the core, and that really limits investing quite a bit. David Kelly, who's the chief global strategist at JP Morgan of their asset management division, has stated that he believes that a default would permanently increase the cost of funding US borrowing from now and into eternity. And then you have former Treasury Secretary Jacob Lew, who believes the impact would be dramatic and immediate, meaning an instant effect on the markets and your finances. Not just to you, but also as a recession, along with a recession that would be almost certain if the US defaulted on our obligations. Some experts predict even more dire consequences than those already stated. Economists at Goldman Sachs, for instance, believe a debt ceiling breach could stop as much as 10% of economic activity, aka crushing our economy by 10% in a short period of time. At the same time, other think tank analysts believe massive increases in unemployment and harmful interest rate hikes would be the norm moving forward. Furthermore, the US economy's turmoil could damage the US Treasury bond market irreparably, weaken the US dollar, and send distress throughout the global economy. With the US dollar as the global reserve currency, this is a big problem to shake the global market and lose trust to such a degree. While these debt ceiling battles are now commonplace, these near misses have not previously occurred during a higher rate environment like the current one. That's the good news, that's the silver lining here. During the near misses in 2011 and 2013, interest rates were set at pretty much 0%. But the good news about the higher rates that we have today is that they might curb the effects of future standoffs and might get people working together in Congress to effectively sort through this problem more quickly. So the question is raising the limit or suspending it. In the now frequent conflicts over the debt ceiling, Congress can increase the spending limit. Congress can either increase or suspend the spending limit altogether. In either case, the relief is really only temporary for the US economy. If the US fails to act and the Treasury reaches the limit, it can only pay bills that it has available cash for. And there are some measures that the Treasury can take to extend the time before default, but these are rightfully called extraordinary measures, and these include things like spending funds that would otherwise be invested for the future solvency of those funds. For example, federal retirement account contributions are invested for growth to meet future needs rather than paid out as current benefits. In a really sad example, the Treasury could technically suspend investments and pay benefits due with these current contributions. Obviously, this would be super short-sighted and would cause major issues across the economy. In a similar vein, the Treasury could halt the issuance of certain securities, although this would probably have a pretty massive effect on things like exchange rates and state and local government revenues. When Congress can't reach an agreement on a debt ceiling increase, but doesn't want to risk a default's political and economic ramifications, it may instead choose to suspend the ceiling for a little bit of time. Usually this is pre-specified and agreed by at least most of both sides. The ceiling is suspended until January 1st, 2025, for instance, allowed both parties to avoid the controversial topic until after the 2024 elections. So, does the Fed have unlimited authority to print money? The answer is a little bit of yes and a little bit of no. The Federal Reserve does not have to physically create dollar bills or physical currency to expand the money supply in our economy. Federal Reserve does not have to physically create dollar bills, physical notes, to expand the supply of money in the economy today. Instead, what the Fed does is buy government securities, which supplies more cash to banks that sell them. The Fed does not pay for these securities with actual currency. It simply credits the accounts of the selling institution. It essentially invents the money at that point of sale, which is the literal example of inventing money, aka the money printers go burr. All right, so what about actual money? US currency. So this is denominations of ones, twos, fives, tens, 20s, 50s, hundreds. US currency is printed by the Bureau of Engraving and Printing at the direction of the Federal Reserve. However, the creation of new physical currency is completely unrelated to what the Fed is doing by increasing the money supply through their methods. Instead, the Bureau prints as much as the Fed predicts will be needed to maintain the current money supply. So the dollars in circulation are really trying to be stabilized over a period of time and not increase. The order is intended to replace bills that reach the end of their useful life in the economy, plus the ones that get stuffed under a mattress. Not surprisingly, the most commonly hoarded denomination in the economy is a $100 bill. Globally, a US $100 bill is particularly popular as a source of security and stability. One of the Federal Reserve's lesser known duties is managing currency production, distribution, and security. This program is housed by the Federal Reserve Cash Product Office, which is one of several specialized functions within the Federal Reserve System that support the entire Reserve Bank operations. Wait a second, but doesn't the Fed supervise banks? Yes, the Fed is responsible for overseeing the safety and conservatism of financial institutions that they're not overburdened. In some cases, the Fed can decide what to require, such as reserve requirements increasing or decreasing, like we discussed earlier, and in other options, it follows the direction of Congress. One option is changes in requirements for banks' capital reserves and the separation of functions like investment banking and commercial banking. The 1933 Glass-Steagall Act imposed restrictions on banking activities designed to reduce the risk of bank failures. Later, the 1999 Gramm-Leach-Bliley Act, aka the Financial Services Modernization Act, relieved some of those restrictions. For example, the legislation repealed the provisions of Glass-Steagall that prohibited financial institutions from incorporating commercial banking, investment banking, securities operations, and insurance. The intention here was to increase competition and not just have a monopoly of one bank having all these services, so consumers would have the benefit of lower pricing on the whole. However, many experts think in hindsight that the combination of functions contributed to the 2007 and 2008 financial crisis. So the rearview mirror is a little interesting when analyzing it from that perspective. The Fed oversees banks according to the rules that Congress makes. This is an important fact. When Congress reduced the needs for smaller banks to meet previously established reserve requirements, the Fed changed elements in its review protocol. This type of change was highlighted when Silicon Valley Bank collapsed, by the way. Because Silicon Valley's size allowed it to opt out of some financial stress testing, this might have had a significant impact on it going under, and we might have been able to identify these risks earlier. However, what's unclear is whether SVB was genuinely insolvent or the victim of public perception. Depositors were surprised by the SVB announcement that it was seeking to raise significant amounts of outside capital. When those same depositors became worried, they started withdrawing from their accounts at a huge pace. The activity turned into an effective modern-day bank run, and ultimately SVB did not have the funds available to meet the demands of that bank run. The Fed's supervision today looks for risk. This includes credit risk, liquidity risk, operational risk, compliance risk, etc. Top to bottom, the Fed is looking for risk. Once the Fed identifies some areas of concerns, the Fed then works with these institutions to remediate and reduce any exposure possible to create a more solid institution. In July 2023, the Federal Reserve proposed a significant boost in capital requirements that would apply to the largest banks. This was called Basel III, or the Basel Endgame. The changes would have increased the capital requirements for these banks by nearly 20%. In September 2024, the Federal Reserve announced changes to the proposed rules that reduced the increase by half. While the Fed did credit the rollback to the reassuring outcome of stress tests conducted earlier in the year, there may have been some influence from prominent industry leaders in banking, including big names like JP Morgan Chase CEO Jamie Dimon, who predicted that the significant increase in capital requirements would make loans much more expensive for consumers. And when the Fed hears things like much more expensive for consumers and businesses, they again think risk. The revised capital requirements include three components. One, the minimum capital reserve requirement for all banks is now 4.5%. Two, a stress-based supplement determined by the stress testing results starting at an additional 2.5%. If necessary, a capital surcharge may be applied to the largest, most complex financial institutions based on their overall systemic risk. So, how does US monetary policy affect investing? Most importantly to you, the investor. Generally, interest rate hikes dampen the stock market while increasing bond yields. Simply put, while the Fed seeks to balance inflation and balance employment, the short-term and long-term results often vary quite a bit. Still, some industries are more impacted by interest rate changes than others. For example, real estate and also utility companies may experience a more adverse reaction to interest rate hikes than companies that do not rely on borrowing as a part of their field. Let's jump into a concept that's pretty widespread, or at least was more widespread. Don't fight the Fed. The essence of this adage is that it's not a great idea for any individual investor to act in a way that contradicts what the Fed policy goals are. Also, betting that the Fed is wrong about the economy's direction is really risky, especially when the Fed is the one pulling the levers to dictate where the economy is going. One reason is that the Fed can influence the market simply by making certain actions. Second, the Fed has a vast range of economic data and research that the rest of us don't have access to, and has layers more than is reported to the public. In 2008, when the world was reeling from the housing crisis, the Fed took aggressive quantitative easing actions. And what they did during that period of time was buy massive amounts of bonds and securities. This action boosted the market really overall by directly increasing the liquidity and indirectly by demonstrating the Fed's intent to stabilize the economy quickly, really by whatever means necessary. So what does this all mean for you? The Fed's actions to manage the US economy impact every single one of us in a ton of different ways. Possibly one of the most obvious ways that it affects you and your financial life is that the Fed's actions to manage the US economy impact every single one of us, and they do in many ways. Probably the most obvious way that the Fed's decisions affect you and your financial life is by controlling the interest rates that underlie all finances in the US. If the Fed sets the federal funds rate at or near zero, you will likely feel the impact in two ways. One, lower rates on loans, and two, lower rates on savings and other deposit accounts. In reverse, conversely, if the Fed increases the rate, you will likely pay a higher interest rate on the loans that you have, either immediately if you have an adjustable rate loan or for future fixed rate products. And you'll probably receive a higher rate on your savings account. So a little bit of good there too. Also remember that when interest rates increase, it may also be more challenging to even qualify for a loan. The effects diversify from there, and this can potentially lead to discouraging investors by being concerned about the economy, and which ends up leading to reduced prices in stocks and other assets. But on the plus side, higher rates will positively affect bond yields and your savings account or CDs. So, what about the housing market in all of this? In late 2019, following 2 rate cuts, the federal funds rate stood at just 1.5%. As the repercussions of COVID-19 started to disrupt the economy in early 2020, the Fed went back to 0% for the rates. So what happened from there? First off, inflation followed, spurred by the low interest rates that were just created, spurred by the economic incentives, spurred by other environmental factors, and a huge amount of printing of money, simply put. In response, the Fed began aggressively raising rates in March of 2022. They then implemented a series of 11 increases over the next 16 months, which ended in a federal funds rate of 5.5% in middle 2023. Mortgage rates, which had dipped to a low of 2.96% in 2021, began rising and reached an average of 7.39 in May 2024. After the larger than expected rate cut on September 18th, the 30-year fixed rate mortgage dropped down to just about 6%. Interest rates are not the only influence on housing sales, but higher interest rates very much negatively impact affordability for potential buyers and reduce interest in moving among current homeowners. Today, nearly 60% of existing mortgages have rates below 4%. I love that statistic. What this does is discourage homeowners from selling, which really kind of gives a backstop to the whole industry and supports it in a way we haven't seen. The impact is complex though, since lower rates can attract sidelined buyers, resulting in higher sales prices overall. Since the US has an ongoing shortage of starter homes, aka a housing crisis, the pressure is concentrated on first-time buyers in the industry, particularly when entrenched homeowners, those that have had their homes for a very long period of time, have huge hesitations to sell. On the plus side, lower interest rates can spur development, which further adds to the supply. In the 5 years from 2019 to 2024, the median sales price for homes in the US, both new and existing home sales, increased by an astonishing 50%. The increase has been even higher in many metro areas, with a peak in Tampa, Florida, reaching over 200%. But as we know, the Fed's influence isn't limited to its control of interest rates. The other tools it uses to balance the economy, such as open market operations like quantitative easing or tightening, also influence US economic performance. Investors who seek to gain from the Fed's actions can enhance their financial acumen and use the knowledge to guide their investment choices. Maintaining a diversified portfolio overall is still going to be the best approach in most market conditions, but very few experts recommend betting against the Fed. For most people, the actions taken by the Federal Reserve have a genuine impact on their specific financial outcomes, meaning the Fed's decisions impact you. Some of the most significant results include borrowing cost and availability of loans, return on savings, prices and affordability of housing. This next one, inflation, unemployment rates, consumer confidence, stock market performance, bank performance and safety, etc., etc. The list goes on. But here's the important takeaway. The Federal Reserve is more powerful than any financial organization we have ever seen in human history. They control more policy, they control more currency, and they have a bigger impact on more lives than any institution we have ever seen. For this reason, investing in the direction with the Fed is crucial to your financial success in your portfolio and for your future. Right now, we see two things as the best opportunities to be on the side of the Fed and to fight inflation. The first is fixed income strategies that are based on hard, real, tangible assets. As the Fed lowers the federal funds rate, which it's been planning to do over the next 18 months, your CDs and your savings account returns will historically go down in parallel with their rate decreases. Moving money from CDs and savings accounts into other conservative fixed income investments is much more likely to protect you from losing money long term as your returns go down. For instance, if rates drop 2%, as the Federal Reserve does plan, your CDs could be paying in the 3% range. If inflation is around 2.5%, which is where it's at right now, you're making less than 1% on your money. You have to think, what is even the point at that point? For you, the investor, you have options. There are funds out there paying much higher for fixed income returns, meaning you know what you're gonna get month in and month out. As one example, at Saint, our income fund pays over 12%. It's based on really conservative assets, and it's 100% backed by real estate investments. So if you want to take a look at what we're doing, or if you want to just learn more or book a call with our Investor Success Pro, check out the link in the description below to book a call and get some information for you to make the best decision for you. Second best option we found to invest in this climate is real estate, particularly industrial real estate. With both political parties pushing US manufacturing, we're seeing a boom in industrial real estate specifically. And we have seen this at Saint over a dozen deals that we've done. We are planning to open up our next investment opportunity to new investors for our next industrial project. So if you're interested in investing alongside us in the biggest growing asset class in commercial real estate, with an operator with a track record over 15 years, then look in the description below for the link so that you can learn more about that opportunity. If this video was helpful for you, you really need to take a look at our deep dive on how the Federal Reserve is going bankrupt. It's a live presentation. We did this to a large audience covering the Fed's financials in depth and strategies that you can use to invest in a market that is in turbulence over the Federal Reserve's finances. Click the link popping up next to me now to learn more about the Federal Reserve's balance sheet and how they're going bankrupt. And if you want to join us for our live masterclass series, click the link in the description below to get a personalized invite.